So welcome to this video. In this video, we are going to discuss about what is budget. And the first part of this video would be like discussing about theory. Then we'll move on to the problems. So the theory would be in terms of case studies. And these are like lengthy case studies where we apply the concepts of budgeting to a particular company. So we'll shall start from the meaning of what is budgeting. A budget is a quantitative expression of a plan for a defined period of time. It may include planned volumes, revenues, resources, quantities, cost, expenses, asset, liabilities, and cash flows. So this definition is given by SEMA. So what is a budget? See, a budget is nothing but a plan for the future. Okay, it's a plan for the future, but this plan is expressed in terms of numbers, and this plan is also for a very short period of time. So short period of time is within a year. So we create a budget only for a year period. Okay, so usually budgets are only for a year period. Beyond that, we don't do a budget. Okay, and budgeting is a process of expressing the predicted cost and resources for a planned course of action over a specified period of time period. Okay, so he said this kind of a definition or meaning tells that a company has a particular strategy which they want to achieve, or they have a particular plan to be achieved. That plan is expressed in terms of, again, cost and resources. Okay, so budgets can be drawn up for business units, departments, products, teams, or entire organization. So budgets can be created for even for a unit, department, product, teams, or an organization. Another term for a budget is financial plan. But budgets can refer to non-cash resources such as staff or even time. So budget is not only for monetary things; it can also be for qualitative things such as number of staffs allocated to each department, or the total time available in terms of machine hours or labor hours, and how that is being allocated to different departments. Okay, so budget is just an estimation of the future which expresses numbers. Okay, and that too it for a short period of time. So that is about the meaning of budget. So let's see how budget is being practiced. The main purpose of budgeting relate to planning and control. So budget can not only be used for estimating our plan in numerical terms, it can also can be used for in terms of control. Okay, so to control the company, budget is like very important here, and supporting the achievement of strategic plans. Okay, so it also helps to achieve the strategic plan of the company. So translating the long-term plan into annual work programs. So a company might have a very long-term program, something like 5 years, what they do, what they want to do, or what they want to achieve. So that 5 years plan is like divided into small 1 year plans. Okay, and these 1 year plans are in turn again broken into per month plan. Again, that 1 month plan can also be broken into 1 week's plan. Okay, so that's how the long-term plan of a company can be broken into a very short-term plan. So coordinating the various departments of the organization to ensure they are working in harmony, a budget requires managers to consider the relationship between their operations and those of other departments. Otherwise, managers might make decisions in their own interest rather than the company's best interest. Okay, so each budget also helps in coordination. Why does it help in coordination? Is it helps managers to see how they are linked with other departments. Okay, so if you take like sales department is like linked with the production department. Okay, so sales is also linked with finance department, because whatever the units they are selling, they will make payment to the accounts or finance department. So they are also linked with marketing department. Okay, they're also linked with marketing department in terms of what is the sales has to be achieved and what is the marketing spend that has to be made. So they are linked with marketing also. So they might even be linked with HR department in terms of employees. Okay, how many employees that the sales department wants. So you can see here that the sales department is linked with HR department, marketing, production, okay, and finance. In this way, all departments are actually linked with each other. Okay, all of the departments are linked with each other in various ways. For example, we can see how purchase department is linked. So if you take purchase department in the center, then see they are not much bothered about the marketing. They are not much related with the marketing, but they are related with production, because how many units to be produced depends upon the raw materials to be purchased. Uh, at what cost raw materials has to be purchased, it depends upon what the finance department tells. The employees to be recruited in purchase department uh, have to be informed to HR department, who employs the staff for purchase department. Okay, and the purchase can also be like linked with warehouse department. If a company has warehouse department, they are also linked with them. So any goods received from the warehouse, okay, uh, the warehouse should only receive goods which are authorized by the purchase department. Okay, in this way each and every department is linked with the other, so no department operates on a separate basis here. So they have to coordinate with each other. So that's what they mean by the second point here. So what about the third point? Okay. So the third point is communicating plans to those who will be held accountable. Each department or individual should understand what role they play in helping the organization achieve its plans. Key individuals are held accountable for the outcome of departments or teams, known as budget centers. So, see, each each departmental manager becomes a each of this department actually becomes a budget center, and a separate budgeting is created for each of these departments. Okay, and these individuals are responsible for achieving that particular goal. For example, if you take, we'll just take these 5 departments and we'll see like what might be their goal. So we take HR department. See, HR department has a goal of like the department is responsible for uh, the the employee cost in the company. So they are the ones who fix what's the salary for employees. So they will be given a target that they should not go beyond a limit. Okay, so marketing has to tell total new sales generated. Sales would be total sales generated, okay, versus target. Okay, finance would be, they have to reduce the finance cost in some manner for overall department. Okay, so usually finance, it's very difficult to give them a particular target. Okay, we can put it like what is the uh, percentage of finance department cost, okay, divided by the total sales generated. Okay, when compared to the total sales, what is the finance department cost? Okay, we can ask like that. Or in terms of the total cost, what is this department's cost? Okay, so their objective is to reduce the cost of their department as well as like other departments. So production, total number of quality products produced. Okay, so each department has its own targets. Okay, so each department will be created a budget and they have to stick with that. Okay, so each department has a target and they have to set within that budget. Okay, so what is about the first one? Okay, translating long-term plans into an annual workable program. Okay, so that also we'll discuss. I think we can discuss that here. So assume that a CEO has a sales target. Okay, CEO has a sales target. So the CEO sales target is 12 lakh units per year. Okay, so he is not going to achieve the sales of 10 lakh units. What he will do is he will appoint managers, okay, sales managers, and he will divide them into divisions. So north sales manager, like that, he might have like 4 divisions. Okay, so there are like 4 divisional managers now. So this full target will be broken into 3 lakhs per annum, so that each of them has to achieve this per year. So now the south zone manager, okay, has his own target, where he will have like several junior managers. Okay, south zone manager alone will have like junior managers, so he might have something like zone managers. So it can be like zone manager 1, okay, zone manager 1, 2, 3, like that. So each of these regional managers, okay, north and these managers will have their own subordinates. Okay, so we are only speaking in terms of the south sales manager. So he has like 4 managers. So this 3 lakhs target will be split and given to all these 4 people. So each of them has to achieve 0.75 per year. Okay, so that becomes a target. So what happens is these managers, okay, might also have a monthly target. Okay, so what would be monthly target? So the monthly target can be 75 lakhs of sales divided by 12 months. Okay, so that will become something like 60,000 units per. So it would be 60,000 units per month. Okay, so these managers, okay, these zone managers have to sell 60,000 units of that product. So that is their job. Okay, so how are they are going to sell? See, this that it's what their job is. Okay, it's what their job is. So we have broken the annual target of 12 lakh units into some regions. Okay, and these sales managers have subordinates called as the zone managers, and these zone managers will then have to have their own targets. Okay, it's not zone managers will go and sell the 60,000. They might have like a particular zone. Okay, so for example, if you take India, in India you have south zone. Okay, in south zone you have like 4 states. So within that 4 states, this so these are the 4 states. Okay, and within then each state, okay, within each state there might be around several districts. For example, if you take a particular state, there are 60 districts. Okay, there are 60 districts, just for an example. Okay, 60 districts. So that means each district, okay, each district there will be a manager. There will be a manager for each district, and that manager has to sell how much units per month? So 60,000 units have to be sold, and there are 60 districts. So each of the district manager has to sell just 1,000 units per month. Okay, so look at how it falls into a lower levels. Okay, so each district manager has to keep on selling just 1000 units per month. Okay, and what is the responsibility? Whether these district managers are selling or not, the zone manager will have track of it. Whether the zone manager is working or not, the south sales manager will have track of it. Whether the south sales manager is like selling or not, the CEO will have track of it. Okay, so this is how a lengthy budget, okay, or long-term budget is broken into smaller parts. Okay, and we can also say that each of them have a target. If they exceed their target, okay, if they exceed of selling that target or meeting that target, then they will be given a performance bonus, and if they are unable to achieve it, they might be given a warning. If they are like again and again not achieving it, okay, they will be kicked out of the job. For example, if the north sales manager is unable to sell, then he would be thrown out of the job. Okay, and a new person would be appointed as a north sales manager. Okay, so only when we set a target, we'll know who's performing, who's not performing. Okay, who's just there hanging in that place, just meeting the target. Like that, we can easily find it out. So that's about the translating the long-term plan into annual workable programs. Okay, so now we'll move on to the purpose of budgeting. So we have already seen some of the points in this explanation, but still we'll go. So budgets can be used for planning purpose, for control purpose. Okay, so we set a plan. So for example, this is a plan. Okay, we control. So whether they are achieving it or not, will be like comparing it on a weekly basis, monthly basis, quarterly basis, like that. So that is control. Which manager is performing, who is not performing, we will also try to know it. Communication. Budgets also help in communication, so that each manager here knows what is their sales target. So that is called as communication. Okay. Coordination. So coordination is something like this, where each department coordinates with the other. Okay, so that the overall the company is like performing well. Evaluation is who's performing how. Okay, so which manager is performing how. So if you have targets, so budgets also work as targets. Okay, so if you see here, budgets work as target. So each manager is given a target and they have to go and achieve that. So that's about evaluation. The next one is called as motivation. So if we fix a target, usually it's motivating. If we fix a target for people, it's usually much motivating for people. And next is authorization. Authorization is approval. So budgets can also be used as an approval. Okay, so what is the sales target? So the CEO here approves the sales target for each of the managers. In turn, each sales manager will approve what's the sales target for the lower people. Okay, so that works as an authorization. And last, it is also delegation. So just like the CEO gives his target to the regional managers, these regional managers give the target to the zonal managers. Like that, it is delegating responsibility. So that's about the concept here about purpose of budget. So we'll move on to what is a functional budget now. So there are different types of budget. Okay, one of them is called as functional budget. So functional budget is itself is a type of budget. Okay, so we could actually put here that it's a types of budgeting or type of budgets. Okay, so within types of budget you have different types. So we have functional, we have fixed, flexible. Okay, then we have approaches to budget. So first we'll see like about what is the functional budgets and all. So functional budget is each department has to create a budget for its own. Okay, so functional budget is a budget of income and expenditure which applies to a particular function of the business. So the main functional budget that you need to be able to prepare are So you should know how to prepare a sales budget, a production budget, a material usage budget, okay, a material purchase budget. So there's a difference between usage and purchase. Usage refers to how many raw material you are going to use in production, and raw material purchase is how much you have to purchase from the supplier. So then labor budget, overheads budget, cash, master budget, fixed and flexible budget. Okay, so we don't need to understand these budgets a lot. Okay, these functional budgets a lot, but we need to understand what are these budgets. Okay, because we also have problems for these budgets. Of course, we have a problem for all these budgets we have, but these are a little bit complicated than the normal budgets. Okay, so let's look at what is a fixed budget here. So I think master budget, we'll just start from cash budget and master budget. So cash budget is, we don't think in terms of, we create a budget in terms of only cash. So we don't take accounting profits, okay, or qualitative items or quantitative items like that we don't take. We only take monetary, okay, items, and that too only cash we take. So non-cash expenses or non-cash any income or anything like that, gain or anything, all those things are avoided. Only cash things are considered. Master budget is, it's a preparation of a cash budget and also a forecasted P&L, balance sheet. So we can tell it as balance sheet, or we can also tell it as forecasted SOPL, forecasted SOFP. I can tell in that terms also. So what is a flip? So that's about master budget here. We try to create a holistic budget, okay, where we try to find out what is the cash that the company will have, what would be the P&L for the next year, how it would be, and what would be the balance sheet for the next year we are trying to predict. Okay, so rather than see, if we predict all these departments, each and every department, if we predict, almost like all the numbers in SOPL and in SOPA is captured. Okay, it's already captured. So we just have to tell how it's how it can, we could use this to create the master budget. Okay, so that's about master budget here. So we'll move on to fixed budget. What is a fixed budget? So fixed budgets can usually be better understood through examples, okay, or through numerical problems. A fixed budget is a budget produced for a single level of activity. A budget will remain the same no matter the volume of sales or production. A fixed budget is not particularly useful for control. It is predominantly used in the planning stage of budget preparation and is often referred to as original budget. So what is a fixed budget? So there's something called as an original budget. Okay, so these are usually the targets. A original budget or fixed budget is usually the target. Okay, so we can say like this: a company wants to sell units it has a sales value, then some variable cost, then they have some fixed cost, and finally they reach a profit. Okay, so sales, they want to sell 1000 units. Okay, amount of sales is going to be 10,000. Variable cost is going to be 4,000. Fixed cost is going to be 2,000, and profit would be 4,000. Okay, so that's about the concept. So this is the original budget. So this target is actually given to each manager. Okay, for example, sales units has to be sales units, and amount is sales manager's responsibility. Variable cost and fixed cost would be like production manager's responsibility, and finally we get the profit. So to set a target that sales manager has to go and achieve 10,000 worth of sales, the maximum cost of production should be only 4,000 and 2,000 fixed cost. Okay, so when you give a target like this, people will achieve the intended target. Okay, but the problem with fixed budget is it's always fixed. It's a target. So targets cannot be like keep on shifting. So you should have one single target for a particular period. So the problem occurs when he achieves some goal. Okay, he achieves a goal. Okay, so this is actual. So actually he has sold 1200 units. Okay, this seems to be 11,000 of sales he has achieved. And production manager, okay, he has achieved, production manager has got a cost of 4,500 for 1,200. His fixed cost is 2,000. And finally we try to find out what would be the profit. So the profit would be, I think we have to work it out. Okay, so 4,500 is the profit. Okay, so now the question is this profit good enough for the company or not? Okay, should we like give a high remuneration or a high bonus for the sales manager or not? Okay, so that is a kind of argument. So how will you argue this? This is based upon flexible budgeting. Okay, so flexible budget is one which by recognizing cost behavior patterns is designed to change as volume of activity changes. A flexible budget should represent what the costs and revenues were expected to be at different activity levels. It is particularly useful for control as the original fixed budget can be flexed to show the costs and revenues for the actual level of activity. So what they are meaning here is we cannot compare the original and actual directly. Why? Because we thought of selling 1,000 units, okay, and we have sold 1,200. See, some of these costs are variable, okay, and some of them are fixed. For example, sales value is variable, okay. The more the items you sell, the different can be the price. Variable cost is by nature it is variable, and this is fixed. So how can you compare different uh, cost and income behaviors in a particular way? So what happens is we have to compare them with something called as a flexible budget. So we create the concept of, so to compare, okay, we create something called a flexible budget. So flexible budget, what it does is it takes the actual units. It takes the actual units into account. So the 1,200 would be the budget. See, this is still budget only. Still flexible is a budget only. Okay. So 1,000 units actual alone we take it, but we take thereafter the numbers of original budget. So how do we take it? Okay, that's a question. So how do we take it is the per unit, okay, the per unit cost of sales, or uh, the selling price per unit, I think that would be the correct. The selling price per unit would be 10,000 by 1,000, right? So the selling price per unit is 10. Okay, this 10 multiplied by the actual units. Okay, actual unit is 1,200. So what is the amount? So the amount would go to 12,000. See, that is he should have sold, as he has sold 1,200 units. Okay, the selling price should have actually been 10 rupees per unit. Okay, so he should have sold at 12,000. Okay, the next one is variable. So the variable, the same logic we can tell. He should have produced at a cost of 4,000. So his cost is, he should have incurred a cost of 4,800. Okay, 2,000 is fixed, so we don't need to worry about it. So the total profit should have been 12 minus 48 minus this. This should have been the profit. Okay, for 1,200 units of sales, okay, this should have been the profit. Okay, so now what we do is we have to compare. What do we have to compare? We will compare what is his actual So we can simply okay. So I think this has to be deleted. So we have deleted. So we have to compare the flexible budget with the actual. Okay. So he should have sold 1200 units. Okay. And he has sold 1200. That's great. But he should have made an income of 12,000, but he has made an income of only 11,000. Okay. So 11,000 is actually bad. That's a problem here. Okay. So I think we should minus like this. Okay. So see, this is a negative one because he should have got 12,000 as income, but he got only 11,000 as income. What is the problem here? The problem is he has sold same units, but his selling price he has reduced. Okay. So selling price has been reduced to improve sales. Okay, so that has been a problem. So should we like give him a bonus or award or reward? The answer depends upon the company. If the company feels that's great, that's fine. Selling the units itself was difficult, so we'll give him a bonus. If the company feels perfect, it can be given. If the higher management feels that no, he has like cheated the company by lowering the selling price, then they don't need to give. Okay, but let's look at what is the production manager has done. The production manager should have incurred a cost of 4,800, but he has incurred only 4,500. See, this is a good thing. Okay, so the production manager should be appreciated. Okay, he should be appreciated. So the next one would be fixed cost is same, so we don't need to worry about that. It is same. Okay, profit has gone little bit lower. Okay, why profit has gone little bit lower? If you see here, when you add, because of the selling price, okay, or sales manager, 1,000 rupees we should have earned, but we have lost. But production manager has done a really good job of saving us 300. So totally 700 we have lost. Yes or no? The answer is yes. The difference between the total profit, we should have got 5,200, but we got only 4,500. So both these are like matching. Okay, both these are matching here. That means because of the sales manager, the total profit has boosted, but still it has not gone to the level where it should have been. Okay, so that seems to be the problem here. So flexible budget is useful for a lot of things. Okay, and when we do a sum, you will get a better understanding about how it works.